Good afternoon, members. We've already formed a quorum, so I call the meeting to order. I would like to welcome Mr. Jackie Liu, PS for Financial Services and the Treasury, as well as his team of colleagues. They're also from the Inland Revenue Department. To save time, I'm not going to introduce the public officers one by one. You've already got a list of attendees available. So we need to deal with one paper first, and that's in relation to the definition of marketed in Hong Kong. So Mr. Liu, please give us an introduction. Sorry, speaker is off mic. Sorry, speaker is off mic. Sorry, speaker is off mic. Well, that's in relation to section 15C. Sorry, speaker is off mic. Sorry, speaker is off mic. The mic isn't working. Well, I think members would record it. For the Hong Kong connection condition, for this condition to be met, there are 4 possible scenarios, including the fact that it is being listed on a stock exchange in Hong Kong, it is being issued in Hong Kong in good faith and in the course of carrying on business in Hong Kong, marketed in Hong Kong or lodged with and cleared by the Central Money Markets Unit operated by the Monetary Authority. By the condition being marketed in Hong Kong, it means that promotional activities are being carried out, say for example, having advertisements here or having offer documents here. Well, in fact, the Inland Revenue Department would look at the facts and circumstances of each case. Promotional activities alone may not be sufficient to satisfy this condition, so maybe the offer document would be needed. We have also liaised with the law draftsman, marketed, whether it is an equivalent for 銷售 in Chinese. In English, marketed or market, it means that to organize a sale by deciding on its price, etc. In Chinese, 銷售 can carry the same meaning. So the meaning of being to advertise, promote, or offer for sale is rendered correctly into Chinese. So we believe that both the English text as well as the Chinese text can reflect our intention. If necessary, the Commission of Inland Revenue would give suitable clarification of the operation through the departmental interpretation and practice notes. So this paper seeks to respond to questions asked by members last time. So if members have no questions, we can continue with our scrutiny. Any questions, Mr. Leung? I would like to thank Mr. Liu for his explanation. If I may ask a question here. Yes, please go ahead. The Hong Kong connection condition, I understand that there are 4 possibilities. I would like to ask a question about one of them. If the marketing activities are carried outside Hong Kong, but then the targets are Hong Kong residents, so can we meet the condition of being marketed in Hong Kong? Does such a scenario is such a scenario being covered? Thank you, Mr. Leung, for the question. Being marketed in Hong Kong, well, the way we see it is that the activities carried out in Hong Kong. In other words, the promotional activity is carried out in Hong Kong, facing the investing public in Hong Kong. And we want to know whether the offer, whether the document is available to the investing public in Hong Kong. so that they can have access to such products. So for the question asked by Mr. Leung, it all depends on the facts of the case. If a company is in Hong Kong and if such documents are issued in Hong Kong and if such documents can reach the hands of the investors, I think to a large extent it can meet the condition of marketed in Hong Kong. If it cannot, maybe we can see if it can meet the conditions listed in 15A, B or D, that is being listed on a stock exchange in Hong Kong, issued in Hong Kong, or lodged with and cleared by the CMU. I think there is already sufficient flexibility to make sure that if they are targeting at the Hong Kong investors, they are likely to get the exemption. Mr. Chairman, if the issuer isn't too sure whether it is meeting the requirements under Section 15, so is it possible to get the exemption first? Because the issuer may not be too sure whether it will be engaged in such activities. Maybe after the bond has been prepared, they may go to Singapore, Malaysia, and Hong Kong. Can they get the exemption in advance? Mr. Chairman, well, the IRD, in enforcing the inland in relation to revenue ordinance, there is this question of advance ruling. So if a taxpayer has worries about their tax liability, it may get an advance ruling from the IRD. I think in this way, the tax-paying company will be more confident as to whether the product as packaged or product as promoted will get the recognition of the IRD in relation to the exemption. Well, since advance ruling would be available, so I think we can avoid the scenario outlined by Mr. Leung. Mr. Chairman, my understanding is that for the interpretation looked for advance ruling, probably the IRD is clearer about this point. There is this prerequisite. You need to carry out business in Hong Kong or a taxpayer in Hong Kong. Please rectify me if I cannot remember this correctly. IRD? I don't think there is such a requirement. Someone may never have any business in Hong Kong, but he may have some activities in Hong Kong, and then there may be some tax liabilities, and he can still apply for an advance ruling. Well, in future, if the IRD would like to include the word marketed in the departmental interpretation and purchase notes, I think probably the wording in this paper will be sort of reproduced in those documents. Your understanding is correct, Mr. Chairman. Members, any other questions? If no other questions concerning this paper, I just want to double check with our legal advisor. Anything to raise? No? Then that takes us back to the cross scrutiny. I think last time we stopped at page 25. 17A. Can we turn to that page, Mr. Chiu? Thank you, Mr. Chairman. If I remember it correctly, I think at our last meeting we reached, if you have the blue bill, we stopped at C1259, that is, we should now start with section 25. I think we can start. For section 25, it says this: if an issuer would like to get the tax exemption, and it comes to his notice that there are certain disqualifying events, then our requirement is that within 30 days' time, the commissioner should be notified so that the commissioner may make a ruling concerning the tax arrangements. So 25(1) reflects this intention. What is said here is that the commissioner should be informed of any specified event. For specified event, you find it in section 23(5). There are two types of specified events. First of all, a BA disqualifying event, and then an IA disqualifying event. So 25(1) provides for such a requirement, that is, the issuer has to inform the commissioner. 25(2), it says that there is this responsibility on the taxpaying company. If within 30 days of the occurrence of the disqualifying event, the commissioner is not informed, then the failure to do so means that under Section 80 and Section 82A of the IRO, penalties will then apply to the issuer. 25(3), it says that if the tax case, say for example there's an application for exemption, and if the IRD has already rejected the application, even if there is a disqualifying event, there is no need to inform the commissioner, because the IRD has already rejected the application, and then that ruling would be final and conclusive, and so the notification is not required. For 3B, it says that prior to the disqualifying event, if refusal has already been announced, it means that the exemption is not to be granted. In other words, despite the occurrence of the disqualifying event, there's no need to inform the commissioner. So subsection 3 talks about the circumstances under which the disqualifying events mentioned in subsection 1 do not require notification. That is, the assessment is already final and conclusive, so the commissioner does not have to be informed in this case. Members, any questions? Mr. Leung? If I may ask this question. For 25 subsection 1, it is said that for the reporting limit, there's within 30 days after the occurrence.
And it says if the disqualifying event is automatically reversed, that is, within these 30 days it is reversed, would the issuer have to report to the IRD? I mean, this is unlikely to happen, but it is not impossible. Well, Mr. Chairman, I think as Mr. Leung pointed out, it would be inconceivable that this situation would happen often. We have in our drafting thought of special circumstance where there can be contravention to this subsection, and after a few days perhaps the situation has changed and the disqualifying event had reversed, and we believe that the likelihood of that is extremely low and it is unlikely that it would happen. And if that kind of a situation does happen, then I think the potential taxpayer should notify the IRD to see whether the IRD would handle the case accordingly. But I do not think that this kind of unforeseeable and a rare situation should be put into the legislation as such. Mr. Chairman, but I worry that the issuer may be an overseas company, not a Hong Kong company. And according to 25(2)(a) and (b), they are penalized. And in your interpretation notes, if you can just clarify that in these very rare situations, even though they may be rare in occurrence, but you will have very clear indications that if there should be such scenarios, within 30 days, there should be notification to the IRD, and the Commissioner will decide as to how the IRD would want to handle the case, so that they know how to read this law. B, I'm referring to 25(3)(b). If there had been a series of disqualifying events taking place, does the issuer only notify the IRD of the first event? Let's say there were 3 disqualifying events and they take place within 3 consecutive days. What about the notification? Is it based only on the first one or all 3? Well, actually, if you refer to 3B there, 25(3)(b), using the same case as mentioned by Mr. Leung, if there had been a series of disqualifying events, the first time of occurrence of the disqualifying event, we would assume that the taxpayer would inform the IRD and the latter would have disqualified the arrangement and the tax exemption would have been made a ruling over, and that ruling would be final and conclusive. So for the investment arrangement and the bond issuance arrangement would not enjoy the tax concession, and there is no room or possibility of a reconsideration of the case. So if this tax exemption is decided, that ruling, that decision is final and conclusive on the basis of the first disqualifying event. So the ruling, according to the law, since the ruling is final and conclusive, any subsequent disqualifying event need not be notified to the IRD because it's not necessary. The first disqualifying event would have already attracted the ruling. Now, if there had not been any final ruling, but there had been subsequent disqualifying events, does the issuer have to notify the IRD of all the events? Yes, the answer is affirmative to that question. Thank you, Mr. Chairman. We proceed. 26. Additional assessments, tax paid in excess to be refunded. According to Section 60 of the tax legislation, within a tax year, or within 6 years of a tax year, the IRD has the right to issue the assessment, the tax assessment, to a person. And here we are affording a flexibility, and that is the Commissioner of the IRD can, within 6 years of the date of the disqualifying event, issue the tax assessment so that the taxpayer will be able to pay the tax to the IRD. So this is 26(1) and 2 giving that flexibility. In 26(1), it says an arrangement and a scheme is an accepted arrangement in relation to a person and a year of assessment if the person's BA claim or IA claim in relation to the arrangement has been accepted for the purposes of ascertaining that the tax chargeable on the person for the year of assessment. And according to Section 60 of the ordinance, with modifications specified in subsection 3, for making an assessment or additional assessment on a person for a year of assessment because of disqualification of an accepted arrangement. And the period of time is 10 years. That is 10 years from the date of disqualifying event. The IRD can issue the assessment and ask for payment of tax. Now, we not only give the commissioner this power to chase for the outstanding tax, but also where tax paid is in excess, in Section 79, there can be a refund of the tax excessively levied to the taxpayer. So similarly, this is applicable to Islamic bonds. 79, Clause 79 is applicable, and 79.5 there, the 6-year time is also applicable, and that is within 6 years after the disqualifying event, the IRD would have the responsibility to refund the excessive tax levied. And bracket 6, the relevant issuer, if the issuer had not raised the situation to the IRD concerning excessive tax paid, but the commissioner is in the know that there had been excessive tax levied, then even though the taxpayer had not, according to Section 79, notified the IRD or the commissioner of the IRD will have to nevertheless refund the excessive tax levied on the issuer, and the excessive tax levied will have to be refunded. So this is the intent of this particular clause, and that is for excessive tax and the refund, and so there is this balance in terms of practice. Mr. Chairman, if I can just ask a question about Section 26. According to Section 60 IRO concerning this assessment, is there a surcharge for this kind of assessment? None, Mr. Chairman. Let's proceed. Yes, Clause 7. Concerning the assessment, the notice of assessment, appeal, and other proceedings on the basis of this ordinance, and also to assessment, additional assessment, or reassessment made under Section 60 or 79 of this ordinance are all applicable in this situation. So I'm not proposing that we repeat all the wording here, but rather refer to them, the relevant sections here. And bracket 8, there may be situations where the taxpayer may selectively contest the tax assessment for particular years, and we believe that this may be unreasonable. And if there should be any objections concerning the Islamic issuances, concerning the tax assessments, then the person will have to do so on a non-selective basis. Rather, it will have to be across the board. That is to say, he cannot object only on the basis of those years in which he had made excessive tax, but rather he will have to make an application for all the years, whether it has been an excessive tax paid or less tax paid. So that is within the entire tenure of the product. That is to say, the taxpayer cannot cherry pick for the years that he is in advantage, or that he would on the basis of the years that he would benefit from the tax assessment. We will be looking at it wholesale in terms of interest rates, etc. We will have to look at the entire situation, and we believe, therefore, that bracket 8 is reasonable. The year of disqualification, bracket 9, is clarified. Questions, members? None. 27. Yes, legal advisor, please. Mr. Chair, I'd like to know from the administration if they can clarify the implementation and enforcement of these of this law, because there are situations where it is unclear. Some parties may not be cognizant of the disqualifying events and what constitutes disqualifying events, and there are possibly situations where the relevant information is not reported to the government, and at the certain time, actually, the person concerned or the issuer concerned may actually fold up the company altogether, and there will be no recourse then. What then? Well, if you look at Clause 24, that there will have to be records kept. And that is, after the issuance, even after the scheme had been concluded, all the relevant information will have to be kept in record. And 26 there, Clause 26, in the tax assessment, the issuer or the company will be bound by law to notify the IRD concerning any disqualifying event happening. And if the issuer fails, there will be penalties. Now, as mentioned by the legal advisor, if there should be a closure of the company, according to the procedures now in place, the IRD would know of the situation. The IRD would know of the closure of the company or the liquidation of the company, and they will make decisions as to and make tax assessments according to the situation surrounding the Islamic bond issuance. And there will be assessment as to whether there are taxes that are outstanding, and at the time of liquidation of the company, the liquidator or the company will be the source of recourse. Yes, we'll follow very closely the cases, even in liquidation situation. And for stamp duty, we will need security against a payment. So in that sense, we have some security and guarantee. But that would not exceed the number of years of existence of the company. So that guarantee is not perpetual, but rather only within the life of the product. Now, if the arrangement concludes, then theoretically we will be able to know and decide whether we give the relief, and where the situation arises that we have to levy the stamp duty or enforce a bank guarantee or give an equal charge claim. Mr. Chairman, as the IRD had explained, the annual tax assessment is done very cautiously to ascertain that the tax assessment is accurate and that is the tax due us will be levied. And the situation as described by the legal advisor at the point of liquidation of the company, we will have recourse to the security so as to offset any tax that is not paid to the IRD under that scenario. So you do not have to worry about that too much. Mr. Chair, I've already asked that question. Well, I think perhaps it is not possible for the IRD to have so much human resources to look into each and every liquidation case. Well, on knowing of a company's liquidation, we will right away send out the latest tax assessment form. And for an issuer of the bonds, in the case of its liquidation, would still be the same as any other companies. And if the company or the issuer would want to empty its balance sheet, so to speak, to avoid any taxes, it would not be any different from any other company trying to do so.
Thank you, Mr. Chairman. We then move on to clause 27. Yes, 27. Well, this is to deal with one particular situation. For Schedule 17A, there is a provision to say that under Section 17, we have the conditions for it to perform in accordance with the conditions. We have reviewed the relevant provisions. We have noted that if the bond scheme has been completed, the assets have to be realized. The assets realized may not be disposed of or sold 30 days within the 30-day limit. Now, this is about the sale of the assets. We don't want this to constitute a delay and disqualify the issuer. So for the purpose of discretion, we are sort of giving the commissioner this discretion. Should there be a delay in disposing of specified assets, and even if it exceeds 30 days, we still allow the issuer to be given the opportunity to explain the matter to the commissioner. If it is to the satisfaction of the commissioner, then the delay will not disqualify the scheme. If it is within 30 days, well, in fact, Section 17 of the schedule already provides for the flexibility, because if it is within the 30-day period, we will not do anything about it. In the case of going beyond 30 days, we say that the issuer must put up a defense. If it is acceptable, then the delay in disposing of the specified asset would not become a disqualifying matter, and it would not lose the tax exemption. So this is to respond to the request from the trade. Sometimes even if you have to dispose of a property, you need some leeway. We believe that it is reasonable for the sake of the market as a whole. We believe that this provision can help the market, and it is acceptable to the IRD. All right, Mr. Leung, if I may ask a question about 17(2)(b), or rather 27(2)(b).
That there was a reasonable excuse for the delay.
In other words, if you can give a reasonable excuse, then in theory you can delay for whatever period you need. It won't constitute a major problem. Sometimes the market is such that the assets cannot be disposed of easily. Say, for example, we may be talking about a few months or even for a longer period. Is that the case? Mr. Chairman, to answer Mr. Leung's question, well, in this provision, as Mr. Leung has read out, the key word is reasonable. I think it has to be reasonable. So the excuse should be reasonable, and it should be to the satisfaction of the IRD. Would it be a infinite delay? I don't think it will be regarded as reasonable, unless in very special circumstances the delay in disposing of the asset is still acceptable to the commissioner. Of course, each and every case is different, and we can't say that we draw a line at 2 months, 3 months, or 4 months. It will be difficult for us to be exhaustive in the provision. But I'm sure the IRD is very experienced in dealing with excuses and check whether they are reasonable. If the issuer is to make a request which is not outrageous, if it is reasonable, well, in fact, the purpose of having this bill is to give out tax exemptions. So we hope that we can achieve the purpose. So we believe that it is better to leave it at the discretion of the IRD, and I think it can be dealt with under the guidelines. Well, Mr. Chairman, for the delay, this is about the investment arrangement. This is the last bit of the arrangement. From the SPV to the originator, that's the stage that is involved. Usually it is an intergroup arrangement. Let me generalize the case. So I really want to know whether Section 27 is necessary, or is there any concern from the trade? So I want to know whether Section 27 was already there in your first draft. Yes. For the specified term, from the first day until it is redeemed, there is flexibility. So if the issuer, if the originator has a problem, say failure to pay the interest for the coupon, or it is impossible to buy it back from the issuer, we are giving flexibility in relation to the delay in disposing of asset, that is to buy it back from the issuer. Well, the asset might have been disposed of, but then the legal titles have not yet been transferred back to the originator. So we just want to give it time to complete the legal procedures. So sometimes there's a matter of delays in the legal documents, or sometimes there may be procedural delays. I agree with Mr. Leung that is usually it will take the form of intra-group transfers or transactions. So generally speaking, Section 27 will not need to be invoked. 28. This is a sort of supplementary provision. We've noted that in many cases the assets can be disposed of in parts. They may be replaced, or they can be disposed of in the course of it. So when we calculate the investment return, the IRD may take into account the acquisition cost in such a way that it is proportional, so that the Commissioner may allocate a part of the acquisition cost as attributable to each part of the specified asset, having regard to all the circumstances of the scheme. So this is to enable the IRD to take care of the calculation of the investment return. So it is a matter of apportionment, nothing special. Members, any questions? If not, then we can continue and we move on to part 3. Amendments to the Inland Revenue Ordinance. Thank you, Mr. Chairman. The majority of them are quite similar, with the exception of Section 6. I'll just skip this one. For the majority of the part, it is said that earlier on, we talked about 17A. To facilitate the readers, we would like to add a footnote in the principal ordinance so that a particular section of Schedule 17A provides for modifications to this section. So we're inviting the reader of the text to note a particular point in Schedule 17A. So it is an editorial convenience. The majority of the provisions in this part are of such a nature. I don't intend to go over them one by one. But then I just want to say that for Section 6, we want to take this opportunity to introduce an amendment. Under Section 14A of the Principal Ordinance, there is a definition for debt instrument. 14A4 has got the definition of debt instrument. In the year 1996, this definition was added. At that time, there was an Inland Revenue Amendment Ordinance. The 24th of May 1996 was supposed to be the date of enactment. But then we did say commencement of the ordinance. We didn't actually name the date. For 14A in the year 2003, there was an amendment. On that occasion, we said that the commencement of the ordinance may not sound clear enough. So maybe we would like to say the definition of that ordinance should come into effect on a particular date. We should have written 24th of May 1996, but then in the enactment exercise, we made it wrong. We got it wrong, and we put down the 14th of November 2003. So there is an anomaly. There's a loophole, and therefore we want to rectify it, and it should go back to the 24th of May 1996. So we want to take this opportunity to amend 14A, Section 14A, so that any debt instruments post 24th May 1996, they will get the concessions and exemptions under 14A. So this is to rectify a former sort of mistake, a previous mistake. We have already liaised with the legal advisor to explain the matter. Thank you, Mr. Chairman. I have some concern here. I want to know whether there is any retrospective effect. What worries me is that if it is to be written in such a way, it seems that you are giving recognition to the validity of the wrong provision. In other words, for those schemes or for those assessments which have been finalized, you can't do anything about it. Concerning the retrospectivity, in fact, in 2B, we have already covered this. That is, when this bill comes into effect by amending paragraph G, we will be giving it retrospective effect. In other words, for the period between 1996 and 2003, for the debt instruments, if they haven't been dealt with, they will still be given the exemption. Yes, Ms. Lee. In year 2011, we amended the law, and we made it to read 14th of November 2003. So it is to cover the period since 2011. There is a sort of a gap since 2011. If we are to rectify it, then the problem won't exist. Well, for the implementation of the IRD, we have already got a degree of flexibility. If there are indeed such debt instruments in the sort of vacuum, we will exercise discretion and give them the exemption. Legal advisor, yes, I can understand the logic of the administration. But then, what about the tax arrangements prior to that gap? In other words, the relevant assessment years may not be limited or confined to the assessment years in the vacuum. It could have been any time since May 24th, 1996, and quite a large number of assessment years are involved. I think you could have drafted it in a different way to say that all those since the 24th of May 1996 up to the time that this amendment bill is enacted. So it should apply to all the assessment years since May 1996 to 24th. I think that will be clearer. You don't just view the gap since 2011. I think it is a matter of during the so-called the vacuum or the gap, you could have been asked to deal with earlier scenarios, and then I'm not sure whether there would be a bearing on assessments earlier on. This is because there can be deferment. In other words, if they have been dealt with earlier, then of course that's fine. Prior to the amendment 2011, we were still adopting the commencement date of 24th of May 1996, but then in 2011 we changed it, and then suddenly we added the date 14th of November 2003. So those that were supposed to be applicable were rendered not applicable. In year 2011, when we amended the law, for those debt instruments issued before 2003, many of them have been sort of completed, or have probably they ran for 5 years or 10 years. So if you count the years, I don't think many of them were still in existence, probably just 1 or 2. The possibility that you outlined was possible, but then it was a mistake arising from the amendment. Can you now you talked about 1 or 2 debt instruments. In year 2011, there was this amendment. Say, for example, there was a debt instrument that was issued in year 2000. Probably 1 or 2 might still be in existence. Did you carry out a check? We did, but then for the time being, well, at that time, we didn't notice the mistake, and therefore, if you see it in this way, then in fact they should have been valid before the amendment.
Yeah. So that is prior to 2011 we were correct. Now, perhaps I should clarify. It was in 2011 that we made the mistake. This is now 2013. We would want to amend the relevant stipulation as soon as possible. And pre-2011, the assessments followed the 1996 amendment, so there were no mistakes there. And also, after so many years have elapsed, there can be a lot of limitations in the stipulations which have already expired, and possibly because of the wrong commencement date and the resulting in wrong assessment, we would want to stamp out that possibility and therefore amend the stipulation. And in terms of retroactive date, perhaps we can look at the actual enforcement situation. Where necessary, we will come back to the panel to give you a full report concerning the situation. Legal advisor, thank you very much for going back to review this situation. I just want to emphasize that the wrong drafting or the situation according to the existing draft, it is still valid, and if that is the case, then the commissioner cannot have any flexibility. And therefore, if there should be any exemption afforded to these taxpayers, in fact, it is not legal. Right, we understand that. We will go back and review the situation, and if there should be outstanding cases, we'll come back to report to this panel. Very good. Mr. Leung. A general question. Part 2 of the amendment bill. It details Schedule 17A amendments. As for Part 3 itself, it incorporates all the 17A changes to put them into the body of the law. Is that correct, my understanding? Yes. Now, if you want to change 17A, Schedule 17A in the future, you can use a subsidiary legislation to make amendments to Schedule 17A. In other words, the LegCo we can only negative vet any amendments you raise, so we'll be more limited in scope and time. Well, actually, this question was raised in the last meeting. If you go to Section 22 of Schedule 17A, C1253 in the blue paper. Now, apart from the Division 2 of this part, we will have to go through the legislative process to make any changes, and that is not through a subsidiary law. And it says that for 17A amendments that can be changed through a subsidiary election is applicable only to Division 2 of this part. And any specified asset transactions, only those are negative vetting procedures amendments. As for the other 17A stipulations, they will have to be dealt with, or their amendments will have to be dealt with through the ordinary legislative process. So it is not the entire Schedule 17A which can be amended by the executive or the administration through subsidiary legislation. But because Islamic bonds are coming up with a lot of innovative products, and therefore we have come up with this particular clause. But otherwise, for others, content of Schedule 17A, the bills or the original legislative procedures will have to be followed. We go on. Yes, referring back to Schedule 17A or the other sections, so I will not go through them one by one. If I can go to Schedule 27 on C1281, and that is concerning an interim period. That is, these alternative bond schemes and bond issuances these alternative bonds are issued under the bond arrangement in the scheme before the date of commencement of Section 3 of the 2012 Amendment Ordinance. So any bonds issued before that particular date, we cannot include them. And there is a mechanism within the IRD where we can deal with the exemption cases on a case-to-case basis, and we will continue to resort to this case-by-case procedure. So in the interim period, that is how we will handle them. But for the issuances of Islamic bonds after the relevant date, we will, of course, follow the exemption as provided for in the ordinance. No questions? We continue. Part 4. Yes, we have completed the Inland Revenue Ordinance amendments, and we now go on to amendments to the Stamp Duty Ordinance. By and large, for amendments to Stamp Duty Ordinance, they reflect the Inland Revenue or Tax Ordinance. So we basically follow the wording and stipulation of the tax ordinance, and sometimes we would actually refer to the relevant clauses of the tax ordinance, so we do not have to repeat them here. So as we bring members forward in this part, you would find them familiar. And in the past 2 to 3 meetings, we would have gone through and explained these changes. And so for the user, they will, of the law, they will have to, anybody referring to the law will have to refer to Schedule 17A as well. And for other situations under stamp duty situation, and including exemptions, we will specify them here so that this can be implemented. Now, first of all, 21, Clause 21, we add Part VA concerning relief for certain transactions in relation to specified alternative bond scheme. The note there is to specify that this part provides for stamp duty relief for instruments executed in relation to the bond arrangement in a specified alternative bond scheme if certain conditions are met. And the relief from stamp duty is afforded to these instruments. This is not legally binding. This is just a note to explain the intent. 47C is interpretation. We are basically copying Schedule 17A to the Inland Revenue Ordinance wording. For example, alternative bond, bond arrangement, bondholder, bond issuer, bond arrangement as financial liability condition, bond issuer as conduit condition, etc., etc. And we have also imbued it with the same definition as Schedule 17A. The two are exactly the same, so the two ordinances can be enforced side by side. That's the intent of Clause 1. On bracket 2 there, especially for Sections 18 and 13 of Schedule 17A to the Inland Revenue Ordinance, the reference to commissioner, in the stamp duty ordinance, it actually refers to the collector. That is a collector for stamp duty. And bracket 3, concerning IA disqualifying event and qualifying bond arrangement and qualified investment arrangement, they refer to 47D in definitions. As for 47C, it is basically just an interpretation clause. No problem? Yes. 47D, again, referring back to Clause 12 of Schedule 17A concerning qualified bond arrangement and qualified investment arrangement, that they will have to live up to certain conditions. The reasonable, including reasonable commercial return condition, bond arrangements as financial liability, Hong Kong connection, maximum term length, arrangements performed according to terms condition. And so this is the same as we have seen in 17A, and it is reflected here in the stamp duty ordinance. And then we go on for the qualified investment arrangement. Again, the issuer will have to also abide by the relevant conditions, and that is a bond arrangement in the scheme from the commencement and specified date of the scheme to the material time has always been a qualified bond arrangement. And bracket 3 there is a discretionary power and the Section 47H6, under the situation described therein, it would not constitute a disqualifying event. So this particular bracket 3 reflects exactly Schedule 17A. And then we go on to define IA disqualifying event. So this is the same as Section 12, subsection 5A. This is a direct copy of that. Bracket 5 is the calculation of investment return, referring again back to Schedule 17A, in particular Clause 11 and 12 concerning the calculation method. And this is also applicable under Stamp Duty Ordinance.
47I
For 47I, instruments to be duly stamped, I want to ask a question about the definition. Sometimes there is a difference between the IRO and the Stamp Duty Ordinance. Now, if a person thinks that there's no need to stamp a document, if that is his subjective view, then he won't take it to the collector. Now here, if you would like to get the exemption, then you must have it stamped at the Stamp Duty Office. You need to have the document stamped. That is under 47I. Another point is that I want to know whether adjudication would be needed. Must it be adjudicated, or whether you just approach your office and then have it stamped? So can you not provide some guidance? We are not yet at 47I, but I'm sure our colleagues can give an explanation. That is the Superintendent of the Stamp Duty. As Mr. Leung has said, documents which are clearly not requiring stamp duty, then there's no need to have a ruling. But then for others, like agreements concerning property transaction, on the face of it, stamp duty is needed. But then, of course, there may be transactions among companies. It is quite clear that stamp duty is needed, but then they want to get a relief. If they can meet our requirements, then they have to approach us, and then they have to get a ruling. If the conditions are met, then we will endorse it and say that it is not chargeable. Then we'll make it clear that for a particular document, it is found to be in line with the conditions for relief, and so it doesn't need to be stamped. For alternative bond schemes, well, very clearly the transactions have to be stamped, but then they meet certain requirements. So all they have to do is to approach us and have it endorsed. We check the documents, and then we will say that we'll stamp it to say that it obtains the relief, and then there won't be a problem. Well, I think to the parties in the transaction, to the market, I think this is a kind of certainty. For a particular document, it should have been stamped, but then as a result of the relief granted, it is no longer required. So by having the endorsement there, it will give confidence. Sorry, Section 13 is about the exemption. I have just missed it. Sorry about that. Legal advisor. I hope the executive can confirm one point. If they haven't given you the original document for stamping, then will there be a record? Well, maybe the stamp office can answer this question. Can you repeat your question? The scenario I've got in mind is that for transactions like those we referred to, we should have been given exemption. But then something happens, it is disqualified. But then the property might have changed hands. So for the party that was supposed to pay the stamp duty will no longer have the documents in hand. Maybe it has already been disposed of, and then the purchaser has already got a mortgage loan. So if someone pays the stamp duty, you give him a certificate. So I want to know whether you would have some records so that in the event that the subsequent buyer does not have a stamp on the transaction, because he doesn't have to pay for it So I want to know whether you will be sort of going back and find that there is a problem. Because if you haven't got a record, then you will think that it is not duly stamped, and you find that it hasn't been duly stamped because of subsequent events. So I just want to know what will happen when there is such a scenario. Mr. Hong, if I may try to answer the legal advisor's question. Say, for example, there is a sale and purchase agreement. Well, there are two ways to stamp the document. Either on the document we put a stamp there, it won't disappear. And then another way is that through the electronic means it is stamped. Again, it won't lose it because the stamp office has got a record on our computer system, so the information will still be with us. So if necessary, a taxpayer may ask for us to provide the information, and then the record can be looked up. You have to record yourself, yes. Mr. Leung. Thank you, Mr. Chairman. Again, a question about the stamping. Want to know about the actual operation. The legal advisor asked a similar question. Say, for example, there are two transactions. Both are asset transfer. For the first one, A to B, the second one, B to C. For the first transaction, A to B, it falls within the regime of the alternative bond schemes. Unfortunately, there wasn't any stamping, no adjudication. They just forgot about it, though they were eligible. And then it went from B to C. It was stamped. It's a normal transaction. And then C later on found that something was missing. If they would like to get it back, I want to know whether there is a deadline, whether there's a time limit. In other words, must that be done within a particular number of years? But if it was entitled to exemption, would you still be imposing a surcharge? I would think so, according to the existing practice. Mr. Hong? Within a particular time limit, it is entitled to a exemption. But later on, they try to make it up. I think they can impose a penalty, and if you can give a reasonable excuse, you will still be relieved. Yes. Either it should be stamped or exemption should have been applied, a relief should have been applied for. Well, of course, we'll look at the date of transaction. Under Section 4, we do impose a time limit. We cannot sort of do anything about it in after 6 years. But if we are entitled to pursue the outstanding stamp duty, we'll do so, and we'll try to recover the surcharge. 6 years for you to get back the stamp duty. Now, if title holder C finds that there's a document lying in the bottom of the drawer, he's surprised to find that exemption hasn't been obtained. Maybe that's 10 years down the road. He asked for adjudication. He has got all the documents ready. Are you going to do it for him? If there is a chain of transactions, if there is a money defect in between, it may affect the title when it is sold from C to D and then from D to E. So how are you going to deal with such a scenario? I try to answer the question from Mr. Leung, if I understand it correctly. C may find that there is a missing claim when A sells it to B, whether there's a time limit for that to be claimed, whether there will be a surcharge or fine for late stamping. Well, going back to the regime for stamp duty, if you have paid in excess, if you want to claim reimbursement, there is a time limit, and it is 2 years. No, they haven't presented it for adjudication. They've never paid any stamp duty. It's not a matter of claiming back excessive stamp duty. Stamp duty has never been paid, but then they would like to get an adjudication to indicate that the transfer from A to B is covered by the exemption. say 7 or 8 years later, they come back to you, and how you're going to deal with it. I think there's a time limit. I think Mr. Hong said that it would be 6 years, and beyond that you couldn't get anything back. If I may supplement, for an ordinary property transaction document, it has to be stamped or relief has been applied for. Otherwise, they can't go to the land registry for registration. So generally speaking, I think the scenario outlined by Mr. Leung doesn't arise. I don't think I would go to the extreme of property transaction, maybe the transaction of shares in Hong Kong. Maybe A, B, and C are sort of associated or related. Well, for stocks, you can't really dodge the payment. If you think that is impossible, I can withdraw my question. But then not everything is in the clearing system. When A sells it to B, it may purely have been in certificate form. I think you need to consider such possibilities. It may happen. In particular, if the transactions go through, are done through lawyers, they will certainly keep a close eye on it. I don't think there will be anything missing. I think it is quite rare for property transactions to be falling into such a category, because you need to go to the land registry. For stocks and shares, we'll check if we can cover the scenario outlined by Mr. Leung. Other than the stamp duty ordinance, there is a statutory time limit. Maybe I'll ask my colleagues to consider whether a late adjudication is still possible. I'm trying to think of a scenario. We aren't talking about ordinary transactions in Hong Kong. Well, stamp duty can be global. I can say that there are clients familiar, known to me. They have had transactions in the UK, in Europe or USA. They didn't know about stamp duties in Hong Kong. 6 years, 7 years later, a lawyer or accountant alerts them. Then they would like to get back the exemption. So they want to set the records straight. And then they are at a loss as to what to do. So I'm not saying that this should be written into the law, because, as the chair has said, it is not common for this step to be missed. This is particularly so for property transaction. But then for shares, if both parties are outside of Hong Kong, it is possible that this step is missing. If they want to enjoy the relief from stamp duty, and if they want to market the bond in Hong Kong, I'm sure the bond issuers will get qualified lawyers and accountants to deal with the case. But of course, we do have a flexibility. For the stamp duty ordinance, we don't have a formal system for advance ruling. However, if the issuer or the accountant or the legal advisor would like to talk to the IRD in advance, I'm sure we can try our best to alert them to the need to stamp the instruments and not to miss it out. So for the scenario outlined by Mr. Leung, I think in terms of implementation, we can cover that. Perhaps the Law Society as well as the accountants can help us by advising the clients not to allow this to happen. Now, the stamp duty ordinance, if the stamp duty ordinance doesn't prevent us from doing this, then we'll exercise our discretion. All right, then we can continue. Thank you, Mr. Chairman. And then we are down to 47E. And that's about the stamp duty relief. First of all, for subsection A, it says that the bondholder is regarded as not having any legal beneficial interest. And as a result of this provision, it means that if the bonds are transferred it doesn't mean that there is an asset transfer, and so the bondholder will not incur a stamp duty liability as a result of the transfer of asset. So for subsection A, this is to safeguard the bondholders so that they are not having an extra stamp duty burden. For subsection B, for alternative bonds like this, they are to be regarded as a bond to which neither paragraph B or C of the definition of loan capital applies. So for the Islamic bonds, either they are regarded as a stock which has been exempted from stamp duty. On the other hand, maybe it will fall into the loan capital definition of stamp duty ordinance. For loan capital in the stamp duty ordinance, again, it won't attract extra stamp duty liability. So A and B are both tax relief.
So that under the existing stamp duty ordinance, they will be looked upon as bonds. And for bonds, the transfer and the trading would not attract any stamp duty as such. So this is to safeguard the investors in their trading of these alternative bonds that they would need to pay the stamp duty. No, they don't have to. 47F, on relief on transactions under qualified investment arrangement. Concerning the investment arrangement under Islamic bonds, 47F1 relieves the compliance from Head 11, 1AA, 11A, 11B, 1221, 23, or 24 in the first schedule under Section 29D2A. If the requirements, as long as it can be proved that the originator and the business entity and the business undertaking or the bond issuer, the relationship and the transactions, if that can be proven, then they can be relieved from these asset transfer or relevant shares or Hong Kong stock transfer stamp duties. So they'll be relieved from such stamp duties. And then in 3 there, it is specified that there will have to be a payment, that is as a charge. And that is at the time of tax assessment. If the IRD is of the decision that the tax need not be paid, then this charge or the guarantee would be refunded, so that there will not be any loss of duty or tax lost. And we have already talked to the legal advisor about that just now. We go on to 47G. Again, the situation of the stamp duty ordinance for other stamp duties leviable according to 29CA and 29DA. These 2 sections relate to these extra stamp duties. Now, because of the asset transfer under Islamic bonds, where there are property or fixed assets transfer that would attract stamp duty. However, for the Islamic loans, we look upon these as transactions that did not happen, but it is only for the issuance of bonds that there are these transfers. And therefore, in 47G, we have exempted them from sections 29CA and 29DA concerning these kinds of conveyancing. I would like to ask whether this refers only to the additional stamp duty. special stamp duty rather under the stamp duty ordinance. So this is not the double ad valorem duty. No. There are two ordinances, stamp duty 2012, 2013 ordinances. There are two different working groups dealing with them at present. And it was in December of last year that we gazetted these, as well as another stamp duty ordinance. We will have to look at the double ad valorem and also the buyer stamp duty burdens that is decided by the two working groups. But right now, we are here only dealing with the existing special stamp duty as contained in sections 29CA and 29DA. So we are not talking about the purchaser stamp duty nor the double ad valorem stamp duty, which are being dealt with by the two working groups, and where necessary, we will be including them for discussions of this panel. Thank you. We carry on. 47H. Relief granted under Section 47F or 47G deemed withdrawn. This is a rather long one. It applies to certain situations where there are disqualifying events where they take place. Then the relevant relief will have to be taken away. So for sections 47F, 47G, they refer to the reliefs from the stamp duty, the ordinary stamp duty. But if there should be IA disqualifying event, then the relief that is already granted will have to be cancelled. And in bracket 2 there, this is much the same as 25 under 17A, Schedule 17A. And if there is an IA disqualifying event, then within 30 days, a bond issuer will have to inform the collector. And for 2B, for any relief from stamp duty, which has been granted by the collector, and there is informing of the collector, then according to sections 47F or 47G, these reliefs can be cancelled if there should be IA disqualifying events. And where the relief is deemed to be withdrawn, then all the relevant documents will have to be forwarded to the collector, and also the stamp duty will also have to be payable. So that is under bracket 2. Bracket 3, it refers to the situation where within the 32 days there is no payment of the relevant stamp duty. There will be penalties, including a fine under late stamping under Clause 9 of the Stamp Duty Ordinance. And bracket 4 talks about the different scenarios whereby non-notification of the collector, there need not be any notification to the collector. And that is where it is early denial of the relief, or there had been a decision which is final. That is to say, as long as the collector had already denied the relief and the decision had been final and conclusive, then this situation need not be notified to the collector. Otherwise, under 47H2, the collector will have to be notified. Otherwise, there will be a level 2 penalty, which is 5,000 Hong Kong dollars. And going back to 17A, Section 27, if there should be any delays after 30 days, then there can be an explanation to the collector, and where the collector accepts the explanation, then there can still be the relief granted to the issuer. Bracket A is a general provision to the content that the collector may remit the whole or any part of any penalty payable under subsection bracket 3. So 47H very briefly is to deal with all the situations under disqualifying event and the relief had been cancelled or withdrawn under such circumstances. Okay, 47I, we have talked about that. Yes, I don't think we need to raise this again because we have gone into details, and Mr. Leung had asked a question concerning the effectiveness of the stamping, and we will not go through that here. 47J is about records and returns. Now, this is applicable only to bracket 1B situation, that is a specified person, it's the originator or the bond issuer under the alleged specified ABS, and he will have to keep the records, and if he is to enjoy the relief from the stamp duty, and the collector may have to refer to the records in the future to see whether there had been any non-payment of stamp duty, if any, then we would request that the originator or the bond issuer keep the records and returns within the 1 year after the issuance of the bond, so that the collector would be able to, under bracket 4, issue notification to request the relevant person to provide the relevant documents and information as kept by that person. And bracket 5 talks about the allowance or the cancellation of relief and the situations under that. If the records are not kept by the issuer according to the time frame, that is within 1 year of the completion of the issuance, then there will be a level 2 penalty, which is enshrined in bracket 6. Level 2 is $5,000 Hong Kong fine. So these documents will have to be kept until bracket 7 mentions the assessment, where the assessment is final and conclusive, and it is irrevocable, or the relevant relief is deemed to be withdrawn, and the stamp duty had been paid up, then these records need not be kept. And since the stamp duty is already collected, or where the relief had been granted or withdrawn, then under such circumstances, the records need not be continually kept. Otherwise, the records will have to be kept for the 1 year upon completion. And we believe that this is minimum and reasonable. We had intended it to be 7 years, but we understand that there is cost concerns for the industry in keeping records and documents, and having talked to the collector's office, we have really been minimal in our requirement, and that is the 1 year.
Any questions? Or our legal advisor has a point to make. Just want to say that for 3B, in the case that a body corporate has ceased to exist, then the responsibility is no longer there. Now, if the relevant person acts swiftly, and when the time is up, it is liquidated, then it means that there's nothing that you can do. Now, do you still need this provision because the limit is 1 year? Well, maybe the stamp duty office can give a reply. Well, as far as stamp duty is concerned, we have this security requirement, so we aren't too worried as to whether there will be abuses. There is liquidation, and then they just abscond. This is every time they come to apply for relief, there is a requirement for security. When something happens, then in fact we can enforce the security within the 6-year time limit, so there won't be a problem. In other words, you are saying that the security will still be there 6 months within the maturity. You cited an example. You said that perhaps at the end of the day, they dispose of the assets to a third party without adhering to the previously determined terms. It is a disqualifying event. 6 years from the disqualifying event, we can still recover the stamp duty. If it is known to you, of course you can do it, but normally, I think when it matures, then you won't be holding on to security. Can you still hold on for six years? Well, upon termination, they have to reinstate the matter, and then they have to send it back to the originator, so they have to apply for relief. If they don't, then the stamp duty office will take action. We'll just check if it is a matter of full compliance with the previously determined terms, or whether some disqualifying events have happened without notifying us. If it comes to our attention, we will take action. Simply put, before we return the deposit, the stamp duty office will do all the homework and check clearly as to whether it is a case which is chargeable or not. We will be very careful because the sum of money involved could be substantial, given the property prices are at such a level, so we can incur a huge amount of money. So it is only when we are absolutely certain that the case won't be stamp duty chargeable shall we be confident that the deposit can be returned to the taxpayer. Otherwise, we will wait and sort out the matter and come up with a ruling before we are to refund the return the deposit to the stamp duty payer. So, in fact, we are quite strict about such matters, and we are quite careful about this. So we will bear in mind the scenario outlined by the LA to see if somebody has absconded or they just liquidated the company and they were not able to recover the stamp duty. We'll do our best to avoid such from happening. Legal advisor, well, just want to clarify the situation. This is because during the term of the bond scheme, they may have a number of transactions right from the beginning, in the middle when there is a transfer of assets, and lastly when they want to dispose of the assets. So at least there will be 2 transactions, and there may be some others in between. The administration has been referring to a security. For every transaction to be relieved, you will get a security, right? So there will be a corresponding security. Does it mean that all the securities have to be kept until the end? Okay, so currently we're talking about 6 years from the disqualifying event. In other words, it cannot be final. Well, it is a conditional relief. In other words, they have to meet the requirements up to the end of the arrangement. So if they have some disqualifying events in between, the relief granted earlier on will be rescinded, and we have to recover the stamp duty. Kenneth Leung. Thank you, Mr. Chairman. If I may go back to 47J. subparagraph 4, keeping of records, I don't have a lot to comment on. But then what about the returns? Why is it that they have to prepare a return? For the return, will the IRD or the Stamp Duty Office prepare a form for those who claim the relief to fill out the form? Do they have to fill out a form from time to time, once every few months? It is quite a nuisance. And for this return to be submitted, is there a similar requirement under IRO? Could I to answer this question, IRD? Mr. Hong? Well, we have a similar arrangement currently. For stock bonds ending registration is a stock borrowing. So if for short selling, we usually grant a relief, but there's also an arrangement. The party involved, once every 6 months, must file a return to us. So it is in the specified form. As to the information needed, we want to check if the transaction has been properly carried out, like returning the stocks borrowed. For the alternative bond schemes, we'll have something similar. So we'll have the existing arrangements. In other words, we'll specify the form in relation to the return. Certain information will need to be furnished to us so that we can examine as to whether the arrangements are always in compliance with our requirements. Mr. Liu? The need for the furnishing of a return. And in fact, they have to notify the Stamp Duty Office of disqualifying events. There's also the need for the security. So we try to plug the loopholes. We believe that given what we are doing, I think all the stamp duty chargeable will be collected. All those that are not chargeable will be returned or refunded. Having a standard form means that taxpayers and the trade can provide the information demanded by the IRD, and they don't have to draft their own format to deal with the requirement. So when we ask for the return, we of course would consider the compliance costs. We try to ease them of their burden. When the form is standardized, we believe that we can avoid getting into the scenario outlined by Mr. Leung, that is putting an extra burden on them. We certainly bear in mind that for the accountants and lawyers involved in tax practices, we have close liaison, and we believe that the extra compliance costs can be reduced to the minimum. Mr. Chairman, what is the frequency of furnishing the return? Say initially you have granted relief if the scheme is for 5 years. Does it mean that you expect a return once every 6 months throughout the 5-year period? And do you expect half-yearly or quarterly returns? Our initial thinking is between 6 months and 12 months being the frequency. The collector of stamp duty will issue the purchase notes, and this point will be addressed. We have limited manpower. If we ask for excessive information, if the returns are too frequently furnished, we may not be able to cope with it. So we have to strike a balance, and we'll keep in view the flow of the assets and to see whether the assets are still in the scheme. Initial thinking is that a return to be furnished once every 6 to 12 months. If the information doesn't change, can it be extended? It depends on the actual circumstances. Maybe the return can be further simplified if it is the same as last time. If the scheme carries on meeting the original terms and there is no transfer of assets, then I'm sure the return can be a very simple one. No questions, we can continue. Thank you, Mr. Chairman. That takes us to 47K. 47K is a general provision. It says that in relation to the above-mentioned provisions, if somebody is to furnish false or misleading information in the records or in the returns, then it is an offense, and Section 60 of the Principal Ordinance will be invoked, and there may be a fine or imprisonment. It is a level 6 fine, $100,000, imprisonment for 1 year. Mr. Chairman, if I may ask a question for false and misleading information. Well, I want to know whether the Principal Ordinance already provides for this. Is it there, Ms. Lee? Yes, Section 60 of the existing stamp duty ordinance. Why do you want to add an additional 47K to say that again? Section 60 is a general provision to say that if you breach any offense, you are susceptible to level 6 fine and imprisonment of 1 year. We have got something similar, but we haven't got the same. Section 55 is about falsifying documents. It's an offense, and under Section 60, a penalty can be issued. For the stamp duty ordinance, in most cases, we have to. Well, for this particular part, this is quite substantial, and if there is a specific legal obligation, I think it's better for us to be specific about the penalties. That is, should there be false or misleading information, then the corresponding penalty should be spelled out here. So it is a specific offense. If we don't invoke this, it means that we have to rely on Section 55 of the existing stamp duty ordinance, falsifying documents, or 59, forgery. We believe that it is not so focused. And if we have got 47K, which is specific about 47J, then we will be able to spell out more clearly that in the case of false or misleading information, it will be an offense. We believe that when it comes to implementation or enforcement, it will be smoother and better. Otherwise, we have to rely on Section 55 or Section 59 of the Stamp Duty Ordinance, and then the effect may not be that clear-cut. But of course, every time when we prosecute an offender, we won't be laying two charges for the same act. This is against the prosecution principles. 47K is a specific case.
47K 咧就係
Mr. Chairman, 47K is specific, and that's about the return and books and records in 47J.
In fact, sections 55 and 59 can be resorted to make prosecutions against the offenders. Now, for the and also for 47K, if there should be any offense under 47K, would they attract the same kind of penalties? Well, yes. As specified in Section 60, any person committing an offense will or is acceptable to level 6 fine or 1 year imprisonment. So if under 55, there should be falsification of documents, or under 59, providing misleading information, or under 47K, offense in respect of false or misleading information. They will all be susceptible to Section 60 penalties, which is level 6, fine or imprisonment. So there will not be any double jeopardy or imbalance of penalties for this similar kind of offense. Yes. Clause 22. VB. Assessment after deemed withdrawal of relief. 47L. According to the new 47H, there are certain withdrawals which, if deemed withdrawn, then the stamp duty will have to be payable. And first of all, there will have to be an assessment of the stamp duty, and there is a mechanism for a contesting of by the taxpayer. And if the balance in the stamp duty is not paid up by the relevant time, then there will be a penalty. An actual fact, under 47L, bracket 7, the additional stamp duty is specified where there is this non-payment of stamp duty within the relevant time. And there is a ratio that is referred to here. And there is a referral to stipulation 47 under stamp duty, which refers to the stamp duty or additional stamp duty payable. So under 47L, it gives us the tool to chase for the stamp duty payable and also the additional stamp duty payable to the ratio as specified in bracket 7. Why is the title deemed withdrawal of relief and not withdrawal of relief? Why deemed? If it's withdrawal, it's a withdrawal. Why do you say deemed withdrawal? Is this a drafting point? Yes, would the drafter please answer the question? Ms. Cheung. Concerning deemed withdrawal, the document is forwarded to the collector for assessment of stamp duty. And at the conclusion of the transaction, the relief is already granted by the collector. But if after that date there should be any event, disqualifying event, then we would request that the parties to the document or the signatory of the document to pay up in terms of stamp duty. But this is not a withdrawal. If it were a withdrawal, then the relevant document will have to be brought back to the collector, and the stamp duty that was originally paid will have to be cancelled and the records changed, or there will have to be a new stamp duty paid, and the procedures will follow. But this is not the case, and that is the stamp duty that was originally given a relief from payment is now withdrawn, and therefore it is a deemed withdrawal of relief. Well, I kind of get it, Mr. Chairman. I think it is confusing for the user. I can understand the drafter's point of view. I will not pursue any further. But if you look at 47L, bracket 7 there, concerning the fines, and 45, section 45, also attracts a fine as well. I think this is probably not cricket in the sense that you are specifying fines under 45, and there were no fines under Section 45. That is for tardiness. I mean, this is 0.04%, even though there might have been fines in the past. There was no specification of the 4 cents per $100. It is not as clear as that. What is, by the way, what is $100? It is the outstanding stamp duty payable. I see. Before, there was this bracket 7. And if we're only talking about Section 45 in terms of relief, and where the relief had been withdrawn, how do you actually levy the fine? Mr. Hong? Well, for Section 45 relief, after the granting of the relief, if the relevant company had certain changes and the conditions as set up by in 45 are not met, then we would request that within 30 years the stamp duty, the relevant stamp duty, be paid. So that is the situation in Section 44. Any fines? That's my question. And what if the stamp duty is not paid within the 30 days? Are there fines? Well, according to 45D, there is a late payment of stamp duty fine specified there. Well, in Section 9, it can be as high as 10 times the stamp duty, but here in bracket 7 here, it says a day rate of 4 cents per $100, and it seems to be going on indefinitely. So would you be extending bracket 7 to other non-payment or tardy payment of stamp duty situations? That is the non-relief situation, but rather non-payment of stamp duty situation. Well, you have elsewhere specified that it can be 10 times that of the relevant stamp duty, but here you are specifying a rate of 4 cents per $100 per day. Then perhaps I would want you to clarify on the differences. Let me supplement, Mr. Chair. Concerning the 4 cents per $100 fine, we are resorting to stipulation 13 bracket 7. If there is a non-payment or only partial payment of stamp duty, then we can issue a stamp duty assessment, and the sum will have to be of stamp duty under that assessment will have to be paid up within 30 days. If it's not paid up within 30 days, then this outstanding duty, additional stamp duty on the outstanding duty to the tune of 4 cents per $100 per day will have to be payable. And that is if the taxpayer does not follow the assessment, and that is pay up the stamp duty under that assessment. As for non-payment of stamp duty, it's another scenario. Under Section 45, there is no such stamp duty assessment issued by us. And therefore, we want it to be consistent with the alternative bond situation, and that is where the exemption is, there has been an event making them unqualified for the exemption, then there will be an assessment issued, and under the assessment, there will be this additional stamp duty payable to the tune of 4 cents per $100 per day. Yes, actually, we have mentioned this point, and we do not see that there is any objections from the industry, and we believe that Section 45 and 47 deal with similar scenarios concerning intra-group asset transfer. And we provide a stamp duty exemption, and if there should be disqualification from this exemption, then there will have to be assessment of stamp duty. And we consider that the situations dealt with by 45 and 47 are similar, and in order to be consistent, we would want the outstanding stamp duty to attract a interest of 4 cents per $100 per day. And in the consultation, we have not met with any negative response concerning this. In order to be consistent in the enforcement, we believe that for 47L should also be applicable to deemed withdrawal under Section 45, and that is, we believe, reasonable. Now, for the normal or usual circumstances, not talking about relief, but a late payment of stamp duty, would you resort to this as well? No. No. Why not? Why not be consistent? But I thought Mr. Liu had explained, and that is to say it has to do with the relief situation. And this is a comparable situation with the non-relief situation. Otherwise, for other scenarios, Section 9 will be resorted to for late payment of stamp duty. Well, actually, Section 9 is very fearsome, specifying a tenfold levy of the stamp duty. Well, I would urge that there be a clear mechanism specified so that those who have not paid the stamp duty unintentionally will not be made to pay 10 times their stamp duty concerned, which is very worrying. Yes, we will go back and review that. Yes, let us stop our discussion here. There had been some meetings scheduled for us in March and April, but because of the filibuster, we had not been able to convene them. Shall we have another meeting on the 30th of May? I fear that that may not come to pass after all, because the 29th of May we have a meeting of the LegCo, and if we can have the meeting on the 30th, so much the better. Otherwise, the 4th of June will be our date of next meeting. Mr. Chairman, if I may submit, our progress had been good today. We have completed all the way up to 47L, and next up would be Schedule 6, so there are not that much we need to go through. And if indeed the 30th of May is not a meeting for us, then I would actually propose that we go for June 4th. Let us have the next meeting on June 4th. And if there should be any other submissions from us, from the administration, perhaps we can deal with them wholesale on the 4th of June. In view of the very good progress we have made today, so perhaps we can save the 30th May date of meeting. All right? And also 7th of June. Shall we also mark that date as well? Yes, so much the better. We can deal with everything on the 4th, but let us also mark the 7th of June. 10:45, 4th of June, next meeting. Thank you very much.